So let's take a look at the liability side. The liability side, we also segment based upon liquidity. In this case, liabilities being things that we owe. Right? These are debts that we have. Debt specifically, though, to non-owners. And so we look at these things in terms of when is the debt coming due. Okay, so current liabilities, generally our liabilities due less than a year. And so we can reasonably anticipate having to pay these things. And so the first one is what we refer to as accounts payable. Now, an accounts payable is the exact opposite of an accounts receivable, right? With the receivable, we've sold something and we expect to be paid at some point in the future. With accounts payable, we have actually purchased goods on credit, have potentially acquired those goods, and then we have to pay the company that we purchased them from. So in this case, we anticipate $220,000 being due at some point in time. Now, they may have different due dates or maturity periods, right? It may not all be due in 30 days. Maybe some are 30, some are 60, maybe some are sooner than that. But we know that we're going to have to pay this sum of money. So it's only fair that we at least account for it to make sure, because it's not like it's a surprise. We know it's going to come up. The next thing that we have to consider are our wages payable, which for this example are $300,000. Wages payable include payments to your employees. You can reasonably expect to have to pay your employees usually every 2 weeks or every month, depending upon your payroll cycle. And so once again, similar to an accounts payable, we do want to account for the expense. We know that our employees are going to want to be paid, so it's only fair that we earmark some funds and make them available for those particular payments. Now, adding together your accounts payable with your wages payable, and you come to your total current assets, and see or total current liabilities, So your total current liabilities are everything that you're going to owe 1 year or less. And so reasonably you can expect to have to pay $520,000 just for your liabilities within the first year. Now, on top of that, we also consider long-term liabilities, which are due over 1 year. And these commonly look like bonds, if you have any bonds that are going to be coming due over the course of obviously a year or more, and also loans. And so in this case, we have a bank loan, so we've taken out a particular loan for whatever reason, and that's $380,000. And so that money obviously is not going to be due for some time, so it isn't something we're going to have to pay right away, but we can reasonably expect to have to pay that at some point in the future. So we do account for that as a liability that one will come due, of course, at some point in time. Now, adding together your total current liabilities along with your long-term liabilities, you get total liabilities, which is all the money that we owe to, once again, non-owners. Now, after that, we do have to consider stockholder or owner's equity. Okay? And this is money that is owed to owners of the company. Mainly our shareholders, people that purchase stock in our particular company, and they have a claim on assets. If you recall from before, it's a residual claim on assets, and so the liabilities need to be met first. Anything left over, if the company is forced to liquidate, gets paid to the shareholders. And so we separate these in a couple different areas. The first thing we have is our common stock. Okay. Now, common stock is not necessarily what the price is on the open market. So if you were to, pull up Yahoo Finance or Google Finance, and if this was a publicly traded company, and you type in the ticker symbol for that company, and it shows a certain price per share, if you were to take that price and multiply it by the number of shares outstanding, you would not get this figure. This is the figure for the money that was raised during an initial public offering and any subsequent secondary offerings. So let's say, for example, that the company had, during the initial public offering, decided to sell shares of ownership for $30 per share, okay? And then it obviously sold, let's say, about 10,000 or so of those shares. We would get to roughly about $300,000. In addition, we also factor in retained earnings. Now, retained earnings is profits that are reinvested. And remember, a company can do a number of different things with its profits. It can pay them to investors in the form of a dividend as a way of rewarding them for their investment, or it can keep them. And there's a very rational argument suggesting that companies should keep profits, because if they pay them to investors in the form of a dividend, they're essentially saying that they have no better use of them. There isn't a better possible use for those proceeds. Now, there may in fact be. And so there's a school of thought that suggests that companies shouldn't pay dividends, really. They should focus on reinvesting that back in the company, particularly high growth companies, so they can fuel that growth. And so in this case, we have $504,000 that were left over from the prior period. So we've kept those. That is money that we have in our possession that we can use towards different things. We've retained them. Now, those two figures together, right, your common stock and your retained earnings, come to your total stockholders' equity, which in this case is $804,000. Now, once we add, once again, your total liabilities here to our total stockholders' equity here, we're going to get this figure, which is our total liabilities and stockholders' equity. And once again, because of the accounting equation, these two figures will always match up. If they don't, there is some type of data entry error, or there's some type of problem. They always add up. They have to add up, because remember that companies have two primary funding sources, either through liabilities and through stockholders' equity.